We expect our bankers to be on the road, to see clients, staff to be together, because nothing replaces the in-person interaction. As it relates to return to office, we target 40% back on premises in 2021. We expect this to be more like in the 60% range in 2022, but still under a rotational model.
Is that because of COVID or just because of the new way you can do business?
I think this is a new way we can do business. You and I have been interacting a lot over the last 2 years digitally. I think it was fantastic because we've been able to connect, to exchange, to share views. But in the meantime, how do you convey companies' values without being in person together? How do you train the new analysts we've hired who've never seen their bosses physically? If you don't get back to the office, get back on the floor. However, I believe that you have to convince employees to come back. You have to make the office a nicer place, a more connected place. Then, there is something in terms of value proposition to accept to commute, to accept to, be in an office and to leave your community. Most of us have been home and have been there, and we see the benefit of that.
It is. It's a tough balance, and I don't envy CEOs like yourself having to make some of these decisions. From a business perspective, you're here on your panel. It's on ESG, something you and I have spoken about many times. Right now, Europe, as you know, is undergoing a bit of an energy crunch. Sky-high gas prices, coal prices, some issues with power availability in the UK. Do you see that slowing down any of the ESG trade, sustainability bonds that have been so hot for you?
Well, first, on the ESG side, Brian, it's the train has left the station. I mean, it's driven by investors, it's driven by issuers as well. And that's really the main trend to have in mind. Just, you like statistics, By this year, we will have seen cumulative ESG issuance for bonds and loans exceeding $3 trillion. On the equity side, by 2020, we had 35 trillion assets under management with an ESG label. And you have a good connection with Europe. In Europe in 2021, 50%, half of the revolving credit facilities underwritten had a sustainability component. As it relates to what you mentioned about England, listen, we've seen bumps, including here on the ESG journey. Same thing, I think the trend is there. The COP26 taking place a few weeks away in Scotland will reinforce the trend. And, if you look at higher energy prices or the more recently climate-driven events, I think it's just going to push the world towards further towards renewables.
Okay, and from a market perspective, because you're investing, you're growing in people. You hired away Deutsche Bank's pretty much entire prime brokerage business. You've expanded in places like San Francisco. Do you have a macro equity market view, Johnny? I don't think I've ever asked you that. Because you're so up here, but I
by the way, I'm glad you've never asked me this. But jokes aside, not so much a macro view, but what I see. I see a shift in momentum, after the last 6 weeks of defensiveness in the markets. We see a better tone, driven by, the Q3 earnings kicked off and pretty positive, including for the banking industry. We definitely see some good U.S. economic data that support or should incentivize the Fed to taper, which the markets want. And in the meantime, we've seen this yield curve, that has been a bit on the higher side for, the 10 and the 30, stabilizing, which I think is all good for equities and capital markets for the next few weeks.